And joining me now to provide insight on the day's market performance is Viv Govender from Rand Swiss Offshore. Viv, thanks so much for your time this afternoon. So tariffs still dominating headlines. On one hand, we saw President Trump doubling levies on steel. And then on the other hand, we see the Trump administration confirming that it is making progress when it comes to trade negotiations with multiple trading partners. This, of course, comes after there were reports of strained relations between both nations. Do you think markets have moved past the day-to-day talk around tariffs and we're just waiting for more certainty?
Yes, at the moment there's a popular term in Wall Street called the taco trade. And taco, TACO, stands for Trump always chickens out. And that basically is the view the market has at the moment, that Trump announces these big measures, but almost invariably, he pulls back significantly from them. And I think that's kind of what the market's looking at right now, that yes, we have all these huge, things been announced against places like China, etc. But in reality, what's really come through has been very little. And in fact, a lot of stuff that he actually did manage to push through was actually reversed by, towards U.S. courts as well. So I think the markets are thinking that, the tariff situation is not going to be the danger or the threat that we thought it was a few months ago.
And following the trade truce between China and the U.S. last month, there were many financial institutions lifting their forecasts for both economies, with some even lowering odds of a recession in the U.S. Today, we heard from the OECD downgrading its growth forecast for both the U.S. and the global economy. U.S. economy expected to grow by 1.6% from 2.2%. Where's your head at when it comes to the U.S. Economy and growth prospects? We look at the job market, it still seems quite resilient.
Look, I'm a bit more optimistic about U.S. growth rates going forward. Maybe not this year, but I, for one, think that the chances of AI and automation, etc., improving growth are quite strong, and we could be seeing U.S. growth rates that are multiples, historic levels, by as soon as 2027 to 2030. And I think that is, quite a near-term kind of thing. But that being said, I do think that the short-term disruptions caused by these trade talks, especially the fluctuations back and forth before, the people got used to it, it's really disruptive. Think about it. If you were in a situation where you were looking at, these tariffs being announced on China, what do? Do you go build plants in the U.S.? That means a lot of investment. But then they reverse and those plants are no longer viable. That kind of uncertainty, I think, is what's really hampering things. At the same time, you see the U.S. consumer may be under pressure, according to some indicators out there.
And talking about, economies that are under pressure, looking at what's playing out in China today, we got those manufacturing activity numbers, and it seems like activity in that sector remains in contractionary territory, with the Caxton PMI hitting its lowest level in more than 2 years. And this despite the big bazooka stimulus measures we've seen coming through over the past few years. Is the stimulus working, Viv, or do we just need more?
We need different kind of stimulus. A lot of the stimulus that the Chinese government has pushed out there has not really been stimulus aimed at improving the economy directly, but often things like bailing out local governments and municipalities, etc., or pushing agendas that are not quite perfect for increasing growth. So there has been a lot of stimulus, like you said, but it's not being directly targeted, at growth only. There's often been, other primary measures or other secondary, aims to be looked at first. And so I think that's one of the big issues around China is, its growth. But also understand that, China is aging very fast. They hit a peak workforce, almost a decade ago, and and now they're heading on a downward trajectory. So they are facing issues, demographically, that over the long term will probably make them, grow significantly slower. One only has to look at Japan and what has happened over the last couple of decades to understand that if you have an aging population, growth at the previously high levels were very difficult to achieve. And remember, Japan in the 80s and 70s were growing at kind of Chinese growth rates in the last decade or so.
All right, let's get into some company news. Not much, but we do have a trading update from British American Tobacco. They expect to return to revenue and profit growth in the U.S., and this despite downbeat tobacco volumes, in the tobacco market. What did you make of that update?
Yeah, look, the thing with British American Tobacco is that, it's obviously in a declining sector, hopefully, because people are looking at health concerns around tobacco. Smoking is not exactly great for your health. There were moves to do things like, as you mentioned, I think in your earlier segment, around vaping and so on. But there's also issues. Vaping is not entirely healthy for you as well. And in addition to that, you do have other players in the marketplace. You do have other especially things from China that have been shown to be unhealthy and damaging the reputation of vaping. But at the same time, by definition, an addicted customer is the best customer. And people that are smokers are, likely to continue to be smokers going forward. And a lot of people that were going to quit have already quit. And so there is this very strong, revenue stream that you have. And where you may not be able to increase sales, have more people getting onto or as many people getting onto the product as you want. But the people that aren't are, like I said, addicted, and therefore provide a very strong, revenue stream for your company.
All right, let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on some counters that have been attracting interest from your industry peers.
And I actually looked at it over the past 25 years. And I broke it up in square meters per year. So 2000, 2021, 2020. When you look at that data, we've seen massive spikes there. Let's call it 2007, 2008. Remember that property boom. Let's exclude that. Mid 2010s to 2020s, we've been able to still complete anything between 2.5 to 3 million square meters of new non-residential properties per annum. Last year was the lowest amount of properties that can be completed. 1.5 million square meters only be completed. That's the lowest levels we've seen in more than 25 years. Where am I getting to? I mean, we're sitting with a company growth point. We know that still, let's call it 0.5%, half of them actually made up of the income in South Africa. They've got very, very low vacancies in South Africa. It's less than 8% currently. The total vacancies is 8%. And with the stock getting less and less, remember, if they're not building new non-residential properties, sooner or later people are going to have a high demand for the properties currently in existence. And I do think that looking at a rolling yield of about 9% currently, with the interest rate that actually just dropped down, a company that's trading at 70% its NAV, 31% discount to its NAV. And again, let's exclude that early 2000s where they actually managed to run way over one times book value. Let's just take an average one-time book value, which we've been able to do around about the 2015s. I think there's quite a bit of upside, plus a very, very attractive yield in growth. But
so Thunder National is one of those African companies we alluded to earlier in the show that is just looking incredibly attractive from a valuation perspective, and a little bit of growth can go a long way. So if we look at a valuation, you're paying a dividend, pay a P of about 8, dividend yield of about 10%. We expect decent earnings growth from the business. Then the resorts is doing much better of late, but also Sunbet, which is the online gambling business, is growing at exceptional rates, and we think that's going to continue with margin expansion. And I think something that's misunderstood perhaps at Southern National is the incredible cash generation the business has. So even though it's trading at a P of 8, on a cash basis, it's probably by 6 times, if not less. So they could pay massive dividends, repay down debt, do acquisitions, and still give you growth. So for me, I think Southern National is offering you an extraordinary opportunity at the moment here.
Skalk and Alex going for local counters, Growth Point and Sun International. Your analysis on those picks, Viv?
Sun International has had a great recovery since towards the end of COVID, quite nicely, but hasn't got to the levels we saw about a decade ago. So it's still down from that point. I do think that in the sector as a whole, there is some bit of upside, but I think the threats are quite significant. We are seeing obviously online gambling, online gaming, etc., becoming a bigger and bigger part of South Africa. I'm sure you've seen the advertisements for sports betting and that kind of stuff. That's really taking off internationally and locally as well. That obviously eats into that. I think also to a certain extent the fact that the rand is much stronger right now does make international travel a bit less attractive for some visitors. That might also not help the company going forward. But there is definitely an upward trajectory for the last few years. On the property sector, I'm always been a bit nervous about it. I think that when we have significant disruptions to the economy, like I'm expecting to see over the next couple of years, because of technology and etc. Property is all about location. Location is all about function. And if you're having the economy change fundamentally, function is going to change, and that's going to make some prices too high and too low for the property sector, which is making it a bit more risky than I would like for at the moment.
All right, and what are you hanging your hat on? Where are you seeing opportunity today?
Like I said, as you can understand, I'm very strongly focused on technology. So I'm looking at Alphabet. They had their I/O recently, which is looking really strong. People often think of Alphabet just as Google, but remember they also have YouTube. They also have Waymo, which is the driverless taxi company, which despite Tesla's hype, is the only one that actually has driverless vehicles on the road at the moment. And they've just passed their 10 million rides. So that shows that business is taking off leaps and bounds. If you look at the valuation of companies like Uber or even Tesla, and add that valuation to Alphabet's valuation, you can see that this company is probably a bit undervalued at the moment, excluding things like I said, YouTube, as well as the DeepMind, AI program, which is at least probably as valuable as what's OpenAI is at the moment.
All right, Viv, thanks so much for your time and sharing your analysis. That was Viv Govender from Rand Swiss Offshore.